Well, welcome everybody. This is Dave Franicke. I'm with the Note Investors Forum. It's June 3rd, 2020, and I'm really happy you're here. I am really pleased that this is going to happen. This is happening today. I have a really good friend of mine, as you can see on the screen, Howard Tenn. He's with Asian Knight, and he's going to be speaking to the topic of mastering the art of knowing when to sell and the skill of knowing when to buy. And I think this is really a really good time for that, just with everything that's going on. And generically, we'll just kind of go through a couple of slides and we'll jump right over into Howard. I show this slide all the time. We're all adults. We don't have to worry about this, I don't think. But again, it's a basic disclaimer. We're given our opinions, and then you can form your own decisions off of that. In this time with COVID, the unrest, not just locally or nationally or internationally, it causes a lot of grief, internal grief for folks. So I was looking for what I could put in here for, if you want to call it a mindset reset. Where are we at? Where are we going? How do you handle it? It's constant in many people. So I found a couple of really good sources to refer to. Dale Carnegie is one, and he had a book on worrying, but basically worry is useless, senseless, and worthless. And don't fuss about the trifles. In other words, don't sweat the small stuff. Use the law of averages to outlaw your worries. Don't worry about the past. And one analogy I really like is, when you're in the car, what's the biggest piece of glass you've got in the car? It's your windshield. Where are you going? Where are you headed? And the rear view mirror, that takes care of itself. It is what it is. And again, that's Dale Carnegie. Harvey McKay had another one, worry pulls tomorrow's cloud over today's sunshine. So that was good. A little bit about me. I've been in and around the real estate industry since 1978, brokering, developing, fixing, flipping, REO agent, sold about 900 homes, and then I've been doing notes since 2013. And I retired my license just last year. If you look at notes, and this is what the subset of everything we're going to, again, notes, getting into notes, getting into anything in real estate is about mitigating risk. But risk comes from not knowing where you're going or what you're going to be doing. If you have the knowledge base, you can do that. And Howard is going to be going over that today in a big way in terms of what you can look at and how to determine what's going on with that. Now, also today, if you haven't or you don't subscribe to DS News, it's a really good site. This particular month, as of today, they have their magazine. I'd recommend you go online. You get it. It's about 100 pages long, probably 50, 60 pages of really good stuff. But it circles everything in terms of what's going on out there right now. It's very good. It's a free subscription, and you get a daily message in your email box. Howard, let's turn this over to you.
Before we get started, I just want to welcome everyone on this Zoom. Dave and I had known each other for quite some time. I have been wanting to do one of these again. The last time I did this with Dave was back in February. And Dave can testify to the fact that the Sunday before the Wednesday, I called him and I said, I think everything's going to be fine, except I'm hearing about this thing called a coronavirus. I don't know what the impact it's going to be, but if there anything is going to derail anything, I think that's going to be it. On Wednesday, when I showed up and I did my presentation, at the end I said, the only thing I believe that we need to look forward in the future are two technological advances that should unfold over the next 10 years, and that is quantum computing, because it's going to make AI even more powerful, and G5, which is going to deliver into your cell phone faster information. Well, fast forward to today, and what we have seen is happening is what I believe would have taken 10 years sped up, and it's going to be at our doorstep within the next 3 to 4 years. So The purpose of what I'm going to share with you as is not about recommending what to buy, what to sell, or whatever, but I use the title what to sell because if you know when to sell, because if you know when to sell, you'll also know when to buy. So I hope you guys find this presentation useful. So can you see that?
Yes.
Okay. Yeah, so the topic we're going to cover is mastering the art of knowing when to sell, the skill of knowing when to buy. This presentation is going to cover 3 major topics: how to measure supply and demand to determine if you're buying at the right price or selling at the right price within reason, how to read a chart to determine the direction of a trend, and the butterfly effect. What does that mean? How to look at 2 unrelated events and see the connection. So why did I choose this topic, when to sell? And for those of you who do not recognize those 4 symbols, those are the question marks that preceded a sentence asked in Spanish. I turned them upside down because people kept calling me and asked me, what do you think is going to happen in the future? And I go, I can tell you, but I'm just going to be as right as your guess. And what I tell them is, we don't know, but what we can do is look to the past and look to the present, and it'll give us an insight of what's likely to happen. And so I want you to keep that in mind, because that's what I'm really trying to depart to you. So we live in a world that is increasingly run by information technology. Powerful people use data, gather the data by using the information technology in order to make decisions that affect our lives. We see this over the last couple of months when the so-called expert comes out and they tell you what you think is going to happen, and the data is showing you this, and this is what we think is going to happen, and then tomorrow they come out and they change their minds. And they keep doing that, and at some point we start disbelieving them, but the fact of the matter is they're not lying to us. They just don't have enough data to produce proper information. I want you to keep that in mind, because when we get to the part that's going to be the most important to you, you're going to understand how to read the data. So the first time I became aware of this was when I went back to college 20 some odd years ago and studied information systems and logistics. And my professor says, data is not information. She says, I own a rabbit, and rabbits can be taught to go to the potty in a kitty litter. So every time I go to Vaughn's, I buy kitty litter, I swipe my card, and Vaughn's, notice I keep buying kitty litter, but I never buy cat food. So they start sending me coupons. Vaughan has data on me, but they do not have information. Data is not information, but a chart can give you the information. Every single data that is out there sits on a chart. If you can find that chart, you can read the data. You can, if you find that chart, you can extract it from the data, the information you need. So because we are real estate investors, we are looking for what is a good price. And price is determined by, and you know what that chart is, supply and demand. And at where they hit equilibrium is where the price really is. A willing buyer meets a willing seller. So let's look at the fundamental chart. That little squiggly line that you see is what you see when you look at charts. This is not this line is not a chart. I created this to illustrate this. Demand in the real estate, demand is represented by buyers. Buyers create demand. Sellers create supply. When the line is going down, the buyers are in command because they can command a lower price. They want a lower price. So as the price is going down, the buyers are in control. When the price is going up, the sellers is in control. But at the point where it hits the apex or the trough, that is the point of equilibrium. That is the point when the buyers and sellers are on the same side. So it's very important to understand how to read a trend. A trend is an upward trend is determined by looking at a series of peaks. You want higher peaks, higher troughs. That's an upward trend. So in other words, the people that are calling me and asking me, when do you think this is going to turn around? I will not know when it turns around until I can see these things. So in other words, right here, you don't know if the trend is up. Up here, you can say, yeah, the trend looks like it's turned. But as you can see over here, this is the problem that we have. We can only see this right here. We can't see this. So here is where you're going to have to make the decisions. And that is what I'm hoping to get you to grasp this concept. This is a rhetorical question. Who is this guy? Edward Norton Lorenzo is the guy who coined the phrase the butterfly effect. He's a meteorologist, and what he basically did was he coined it, and everybody knows it like this. A butterfly flaps its wing in Tokyo, and there's a tsunami in New York City. But essentially what it is in a complex system, there are a whole bunch of things that are interconnected. And if you don't pay attention to them, you get blindsided. And so when it comes to real estate and note investing, where are the butterflies? And I'm about to show you that the butterflies are interest rates, mortgage applications, unemployment, single family home, medium price, housing start, and yes, the stock market. So Dave sent me this chart. This is a chart he pulled off Wolf of Wall Street. And what this is showing you is the medium home price, single family home sold. This is the medium price, the long-term view. As we can see from 2000, it's been going up, it goes down, it goes up. And right now we're seeing that it is somewhat going sideways. And that red line was put there by the chart maker. So when I look at that, this is what I do. I put my lines on it. And what my lines are showing me is that in 2008, when it came back down, I can see the band in which it was confined in. I saw where the top, where the equilibrium changed and the buyers took back control. And then it came down and the sellers took back control, and it goes back up again. But here is what you really need to look at is this. What that shows you is something that is very important. Let's take a look at 2000 to 2004. That's 4 years, right? Then from 2000 to 2007, it topped out and started going down. How many years is that? 3 years. And then it went down and it pretty much started going back up again. How long did that take? 3 years. Then it went back up to the previous high. How long did that take? Just over 3 years. And then it went, and then we're now 2020 and we're sitting here. So my question to you is, looking at that chart, you see a pattern. The pattern is the natural rhythm is around 2.5 to 3 years. So knowing that, and given the fact that we don't know where we are right now, if we're at the bottom, if today is the bottom, based on historical information, how long do you think it's going to take for it to go back to where it was? 2.5 to 3 years. So here is a chart that I also picked up off the same website, but Dave didn't send it to me. Pending home sale of existing home collapse. So what we looked at here is 2000, we look at this all going up. How long did it take to go up? Then it came down. How long did it take to go up? Then look at this. From 2000 and middle of 2015, what are we seeing here? The median home prices have been going down. Now, we being humans, we only know what we can see, but the computer is looking at everything. Then it started going back up, but it was never able to get back here because the coronavirus did that. But the price at which it is right now, if this is the bottom, how long is it going to take to go back up here? And that is what we learn looking at charts. Because we can go back and look at the price levels, and we can see where when the buyers take back, when the sellers take back in control, how long, because the sellers have to come back into control, the buyers have to come back, the sellers have to come back in order for you, because if they don't put the inventory there, you can't buy. So let's talk about the butterfly effect. I threw this up because this is the interest rate at 54 years of the 10-year Treasury. So the question is, why did I choose the Treasury? Well, I'm going to tell you right now, the 10-year Treasury, as a mortgage loan originator and a banker, that drives everything for me. That's how I price my loans. But what I want to show you here is not that. If you go and talk to someone in their 50s or 60s or whatever, and you ask them, you think interest rates going to go back up? They're going to say yes. And they think it's going to go back up over 14%. And if you look at this chart, what you've seen since 1980, it's been going down, 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 down. But what you're not seeing in this chart is this. What I did is I took a section of it. And what that section is the previous recession from 2008. So what you're seeing is the interest rates go down when the economy slows down. And the interest rate goes back up when the economy is heating up. What you will see is every time over the since 1980, they try to raise the interest rate back up, the economy collapses and it has to go back down again. And then they try to do it, but they were never able to get it back up to the previous one. So I'm going to tell you right now, and as I said to Dave and I will probably never see interest rate back at 4% in our lifetime. Because in order for interest rate to get back to 4%, where the treasuries are now almost 0.5%, it has to go up 3.5% to get there, but it's not 3.5%. It is 700% increase in order to get there. This is the unemployment chart. Let's take a look at it. You can see that the unemployment was the highest in the middle of the chart. Back in 2008, the unemployment never rose to that level. But what's more important, you see that blue line down at the bottom? The unemployment can never seem to drop below roughly 3.5%. That is because it's something called structural unemployment. People they lose their job, they decide to stay out for a little while. Women go home to raise their family and stuff like that. So anywhere around 4% is considered to be full employment. So prior to the coronavirus, we were at full employment. Then all of a sudden, look at that. But look at where it is in relation to the all-time high since 2020. It's not just above it. It's what, 11 over 14? That's 3% more. So 3% of 11, it's almost 30% higher than the highest it has ever been. Let's look at housing starts. The historical housing starts. We see in 2008, it started going down, 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 and then it stopped and started going up, and it comes back down. The coronavirus brought it down. So let's assume that right now, because you keep hearing about pent-up demand and you hear about there's not enough inventory and everything, and I'm not going to argue with them. I'm just saying, if you're true, show it to me on the chart. So what we see here is that housing starts have dropped to this level. If you take this level, what will it take to go from this level back to this level? And if I start counting, I'm about a year and a half out. So that means is if this is the bottom, the most optimistic thing I can believe is going to take at least a year and a half to get back there. But it ain't going to be tomorrow. I might be wrong, but I know it's not going to be tomorrow. And we're never going to know until we get to define this bottom. I pulled this chart up, and it's really very interesting because over the years that I have spoken in front of you guys and meet up with you guys and talk with you guys, I always ask this question. And the question goes like this. If I gave you $1 million, put you in a time machine, and send you back to the point in which real estate prices are bottom, and told you you only can buy stocks or real estate, what would you buy? And inevitably, the answer is always real estate. And my answer always was, no. I said, knowing what you know now, you're telling me you wouldn't buy Amazon, you wouldn't buy Apple, you wouldn't buy any of those stuff? And once I clarified, they realized it was a trick question, even though it was right out in front of them. So I pulled this chart. What this chart shows is at the bottom here are trading days. There are roughly 240 trading days in a year. And what this is, it's the percent change of the S&P from January 1st. And the dotted line is 2009. So what we saw that in 2009, the stock market bottomed and started upwards. What we're looking at right now, this thing bottoms just around the same time. And look at what it's doing. It is tracking exactly what's happening to the stock market. Now, can I tell you with all certainty this is going to go? I don't know. All I can tell you right now is what I'm seeing. 120 days is 6 months. 6 months is the end of June. So at the end of June, if this is right, this should come back to zero. This should come back to the price it was at the beginning of the year. But we can also see this bounce around right here. So watch out for that. This I want to share with you because I think this is probably the most important part of my research. And that is Zillow.com and ZHVI.
Yeah, correct. Okay.
So let me explain to you something about Zillow before I go into this. Zillow came into our consciousness back in 2006. I invested in Zillow because I realized that for the first time, people could see what the value of their home was. The problem and the knock on Zillow was that these estimates were unrealistic because they were always way too high. Most people, and including myself, didn't realize that what Zillow was doing is that they were purposely doing that. And the reason they were purposely doing that, because if they made it too low, the people who own the house would get pissed off. And so they decide to make the homeowners their target audience. And so what Zillow did is Zillow did not have enough data. But since 2006, we are now in our 14th year. And in June of last year, Zillow redid the way they calculate their pricing. And the pricing they use is called a ZHVI. If you understand how the data is compiled, you're going to realize how powerful using Zillow is. Because when I got into the note business, the first thing they say to do, go and try and ascertain what you think the value of the house is, so you'll know what to pay for it. And so we would go and we go look at Zillow, we go look at this, we go look at that, and we go look at, we're trying to look at everything to decide how to determine it so we can make our bids, because we don't want to pay for the BPO. But let me explain to you before I show you what's on the screen, how Zillow compiles the data. What Zillow does is they're now using artificial intelligence. They're so good that when a house that goes up for sale and include pictures, Zillow is using the computer is looking at the pixels that created the image of the picture, and based upon that, they can tell you, the computer can tell you whether it's granite, not granite. They can look at the agent, they can look at a lot of things. In other words, they can do what an appraiser can do. Very important that I explain that to you, because I got to put it in context. Because if I don't put it in context, you're going to look at the charts and you're going to draw the wrong conclusion. What Zillow now does is Zillow has better data that's coming into the information. But the data lags, and the data lags about 2 months. So whenever you see the price that Zillow puts out, there are two things you have to understand. First of all, you have to understand they're 2 months behind. Number two, it's an average. What that means is the price you're seeing, it doesn't mean that's the price of your house. It just means that's the average price that's in the area. And if you are an appraiser doing comps, you have to look at everything and say how close you are to the average, and then what do I need to add or take away in order for me to give a full appraisal. So what you're looking at, by looking at Zillow, you now are able to do something that's really very powerful. If you look at the Zillow pricing, what you're looking at is what the average price is based on the search criteria. And if you believe you're in a buyer's or upward bias, you can put an offer in a little bit above Zillow price, and you can use the Zillow price as an argument in order to close the deal. Or if you're in a downward stuff, you can show them the price and come on the downside. And the reason I use Zillow is because I'm also a reverse mortgage specialist. And the value of the house that I use is going to determine how much loan they're going to get. And if I get it wrong, they're going to get less money. If I get it right, they're going to get this money. And if I'm wrong and to the upside, I'm going to get more money. And sometimes that can kill the deal. So before I go to the thing, look at the Zillow as an average. That's the average price you're looking at, delayed by 2 months. So if you're negotiating with a guy and Zillow is saying 100 and he wants 200, he's crazy. Whatever he wants, look at the percentage above that and ask yourself, are you willing to pay that? Because you can go back to look at the other charts and say, well, if I pay that within 6 months, I'm going to break even. That's the power of what Zillow is, and Zillow is going to get better and better and better and better at it. So here is one thing before I go over. Human beings, when given a piece of data, start forming their impressions. And at a certain point, they develop confirmational bias. So when any additional information comes to them, they're going to argue with it. Are they going to argue for it because it confirms their bias? What they don't do is they don't go all the way back to their past experience and recalculate. That is what the AI does. And that is why when the Fauci and Barr came out and keep changing, that's what they were doing. And that's why they were losing credibility, because you didn't understand what they were doing. they didn't have enough data to give you an accurate information. That being said, I'm coming over to the chart now. Can you see my mouse thing? I just want to confirm people are seeing it.
Yes.
Yeah.
And
Yeah,
how, I want to ask
okay.
you a question. If you were in front of either a home seller or you're buying a note and you're looking at valuations, and let's say that you're buying a note and you say to that note seller, I'm having trouble with valuations because yes, Zillow said it's worth 200,000 now, but that was 2 months ago. So we just came through the COVID crisis and things have changed. How would you couch that to that seller other than saying it's information from 2 months ago? How would you move that forward?
If you hold a question, it will naturally going to answer that, but I will circle around to clarify it.
Okay.
Because it's all in this Zillow ZHVI. So
Okay.
because this is a Phoenix meetup, what I've done here is I have chosen Phoenix. If you look at the graph, you see how it's boxed in.
Yeah.
Well, this average price is calculated within that box. And what it's saying is that it's 269. The average price, medium home price, is that. And what they're forecasting, and you can see right here, the price have actually started to go down under the COVID. And then you see all of this. So right now, just looking at that, I am telling you that we're in a downward trend. As shallow as it might be, it's still a downward trend. So if I was to make an offer on this, I would not be paying 10, 15% above that price. Because if I did, I might find myself 15, 20% below the new value. That's how you read that chart. You can see right here, it tells you the market is very hot. You go down here and it starts giving you a bunch of things. Here it tells you the changes, they don't have any data here. You can see that in 2012, it started going up. It kind of go flat right here, but it has been pretty much going up steadily until about March 20th. In 2020, somewhere in March. I would assume it's when the shutdown happened, and then it starts to go down, and we're right here now. Okay, even though even though it's saying May, the data itself is still 2 months behind, because the way the data is constructed, it uses a whole series of variables, and one of the variable is actual closing and recording, and that, because that data confirms more than anything else, it's given the highest weight. It might even influence the chart by as much as 50%. Since I don't know what it is, I have to assume, unlike a stock, the data is lagging. The data is lagging. So to answer your question, let's take a look at this right here. You see that right there? You see that little bump underneath here? This is a forecast. This is not what's going to happen. This is what they think is going to happen. The only thing we know right now is this little piece. It's going down. So let's say they are right. If I draw a line from here all the way back to here, right, to line up with that, then basically prices are going to go back to the beginning of the year. But what happened if the price came right down to about here? Then we have to go all the way back here and we say, oh, man, the prices are back to 2018. That's how you use this. You come down here. Here is the number of days, average days that are on the market. So back in 2011, going forward, what do you notice here? what you're seeing is the number of days on the market are dropping, but that shouldn't surprise you because that's what's been happening.
Right.
If the number of days on the market are shortening, it means the sellers are in control. They're getting their price because it's rising. So why don't we do this? This is Phoenix. Dave, can you give me another?
Yeah, a lot of folks invest in Indiana. Let's try South Bend, Indiana by Notre Dame.
Indiana. Okay, so this is Indiana, and you're looking for South Bend.
Right.
So I come all the way down here, and here is South Bend, and I come here, and it tells me in South Bend, the average price is 111,000. Here is where it tells you in terms of the data is governing right here. What happens if I do this? Do you think I could find your house?
Yep.
You think I could find your house? And then it comes down here, and again, we see the little dip. But if you notice, the little dip is a little bit more steeper than Phoenix. So you come down here, and you can see the number. If you go back and you compare this to Phoenix, you'll notice Phoenix didn't have this. Phoenix never had a time where the average amount of days on the market was ever higher. It just kept going down. And we know before the COVID, Phoenix was the hottest selling real estate market in the country. Okay. And they also have sometimes they will tell you here, they have no data on the number of houses that have negative equity or in delinquency. I was really shocked in putting this together how much Zillow had improved and how you guys can use it. So did somebody else want me to put something else in there as the last one?
Well, yeah, let me ask you a question on this one.
Sure.
Here, Howard. So a lot of the folks in the call here are doing seller financing where they may be doing wholesaling on houses, but they're also offering seller financing as an option to that homeowner.
Yes.
And now we know where the pricing is going based upon the Zillow projections.
Yes.
And you can see the dip there. So what that's telling me is where last year we were trending up, this year we're trending down. So no matter if a homeowner is drunk on value, you could basically say, look, we're going down, and this is from 2 months ago. Would that be the proper approach to it?
Well, one of the things that I wanted to stick to in the focus of this is not to actually give you individual advice, but I'm going to answer the question. Seller financing are the model that are being taught out there is you can buy something and you can sell it at a higher price than because you can mark it up. And so the mindset is always, how much can they afford to pay because they can't get financing. So it's always revolve around their ability to pay. And then you reverse engineer to get your price. You can still do that. But if you look at Zillow and you realize your price is 10, 15, 20% above the Zillow price, you got to ask yourself, are you really as altruistic
Martha,
as
how are
you
you?
think you are? Or are you really screwing the person?
Good, thanks.
Right. Okay. Guys, you're online. Type in a city. Let's look at another city just for the heck of it. And if you want to type one in the chat box, and we'll pick it out of there.
Let's look at Riverside since I'm from California.
Okay.
So there is the average price of home that Zillow is saying, right? And look at what it's saying right here. The two places we looked at, we saw hot. Now we see warm. Whoever asked for Riverside probably recognized the area. And we can come down here and we can see this. It's a little steeper right there. They don't seem to have any medium listing price right now or medium sale price right now. They're forecasting. It has been, price has been down about 2.3 for now, year over year. And this has been the average days on thing there. But I want you to pay attention to this. You see this little thing right here where it goes up and down and goes, it's almost like it's going sideways. So what I would say in 2015 to roughly 16, 17, and 19 gave us an idea what under these market conditions, you're looking at about 102 days on the market, roughly about 100 days on the market. So, if you, right now, you can see it's crawling up. The longer it stays on the market, it means, guess what, guys?
Prices are coming down.
Prices are coming down. The buyers think the prices are coming down. So at the moment it hits right here, if it's up here, go back and go back and do your research and figure out what happened during that time. It will tell you. It will tell you.
The W's are repeating themselves, aren't they?
Pardon?
The W's are repeating themselves.
Yes. And when you see W's, that is really where the price range, the real price range is at the time. The market is in gear, it's in equilibrium. The top is not the very top, it's always within a range. So it gives you an idea. All this can do is, it can tell you whether the wind is at your face or the wind is at your back. That's all that this can tell you. And if you get in right now, how long do you have to wait before it realizes itself? And if you say, okay, it's a year and a half, and 2 years have gone by, and 3 years have gone by, you're fooling yourself. Something's fundamentally changed. Maybe you should have gotten out. Maybe that's when you should have sold. You should have sold because it's not happening.
Bingo.
Okay. So let me see if I can get back to...
And Howard, let me interrupt you for a second. We had
Sure.
2 requests from Houston. Can you just pick up Houston? That would be, is that 77386? I think that would be a good one.
Oh, they wanted another one?
Yeah, let's do another one because we got 2 from Houston. That's a unique,
Okay, so let's go back. As long as they, I don't want to take... So what did one of them wanted?
77386. It should be Houston.
Okay, it is coming up.
Look at that, cold.
Is that Houston? It doesn't tell me what that is. Got to make certain I know what it is.
I thought that was maybe Houston. Maybe it wasn't.
It is showing me. Whoever asked the question, looks like where you wanted it to be? I am seeing Rayford. I am seeing Porter Heights around it, Sleepy Hollow, Woodlands, Shenandoah. Did I put in the right thing?
That must be Virginia then.
Pardon?
That must be Virginia. I just saw Houston. I thought it said Peter 0505. I thought that was Houston, Texas.
Doesn't
matter. Doesn't matter.
Ask Gaelic. He's driving. It's Peter Gaelic.
Yeah.
Okay. Give me the other guy's person. The other information.
Houston, Texas.
Houston, correct?
Yep.
There you go, Houston. So this is Houston. And
Look at that.
What do we see? And keep in mind, guys, that even though you're looking at this, in your mind, this is what you see.
Look at that, Howard. It started to dip before but it's a similar dip. but it's a little bit different, and obviously the cooling down effect.
Correct. All I can tell you is this, guys. Do not take the data as absolute and make decision on it. Take the data as one data point. Go back and take a look at other things so that at the end of the day, you are able to make a better informed decision. Because I'm going to tell you what happens when you're holding a position and you're in a loss position. You start looking for people to encourage you to stay there. And they will tell you everything. But unless it shows up in a chart, you cannot confirm the data.
Question, Howard.
Yeah.
So if I'm looking at a pool of notes and it's a push-pull with the note seller, and my analytics are tight, meaning loan to value, and I run this analysis, this is giving me a trend. If I'm going too far off the board, let's say I'm looking at something that's got a 65% investment to value, loan to value, doesn't matter, and the trending is down, it's like, okay, Dave, you got to pull back and show that to that note seller, dude, this is going sideways. I cannot pay you what you want. Is that a fair assumption?
Yes, but the way I would coach it to him is I would, and I'm going to look at just one note. If I'm looking for a note and I put an address in there and I see this number and I know I'm going down, I could say, whatever he's asking me for, what is the loan to value? So if I run the number and the loan to value is 60%, then I have to say, if I buy this, I have to assume that this price will hold or go higher. Otherwise, my risk increases. So one of the things I have to then look at is I have to then say, it's trending down. We don't know where the bottom is. But so can I, instead of offering him 60% loan to value, I'm going to assume I'm willing to take the risk that this thing will drop another 10%, right? And then from that, I reprice at that and at 60% loan to value. Now I've built myself a 60% cushion that if this comes down, I win. I don't have to worry about it. Because remember, if you're buying a non-performing note, you're going to sit on that sucker for at least a year and a half.
Well, to that point, I was looking at a non-performing note in Northern New York, which I don't like anyway. But with the state being shut down and an 18-month time frame to foreclose, it's like, man, that's a lot of exposure just on.
Yes, and you have to.
Going on, it's like, really.
But more important, Dave. More important, I want the people on this impart to the people on this Zoom, is that this is what is projected. This is not what's going to happen. But let's make the assumption that this is what's going to happen. Right. Let's say God comes down in your dreams and say, yeah, trust what Zillow is saying. At this point right here, can you see my mouse?
Yes.
If I back that up and go back here, that is the price of the home. And you can, that was back in 2019.
Right.
That's 2019. So if you want a 60% loan to value, you better take that value and do your calculations.
Yep. So that's why buying with a cushion is important. You can allow for that.
Yeah. Like I said, and I want to make you understand, data is not information. Data, every single piece of data that you're given sits on a chart somewhere. The internet can find it for you. Once you find the chart, and if you know how to read the chart, you can extract the information. Okay. You can ignore what it's telling you and go do whatever you want. That's always your choice. But you are taking a calculated risk. And that's all you can hope to achieve, to take a calculated risk. And this, what I am showing you is how to do that.
Got it.
All right. I am going to wrap this up so we can deal with questions. And anyway, it says, so one of the reasons why I asked Dave to come back in is because I will be starting a monthly Zoom meetup, again, titled When to Sell, where you can come and learn how to read charts. All kinds of charts, whether it be interest charts, stock charts, Zillow charts, any kind of charts, how to learn how to read the charts. What I showed you on the charts were charts that were marked up. I want to share this with you is that in 2017 in December of at a Christmas party, someone asked me, what do you think of Bitcoin? I go, I don't know. I don't think about it. And they said, well, at that time it was around 20,000. And they said, well, where do you think it's going to happen? I say, show me a chart. And they show me the chart. And I look at them and I go, based upon that chart, here's what I see. It's in a parabolic move, which is a precursor to a bubble. And when the bubble bursts, it should come down to about 10, 12,000. Then it should bounce back and somewhere between 15 and 16. It should go sideways for a while. If it breaks to the low, look out below because it's going to come down somewhere between 3 and 5,000. And lo and behold, it did exactly what I said. And so I got a series of calls and they say, how the hell you know what's going to happen next? I said, I didn't know what was going to happen to Bitcoin. You could have showed me a chart of real estate or avocado pears or the US dollar. I would have tell you the same thing because the chart was telling me what is likely to happen. I could have also been totally wrong. But the bottom line is I'm able to make an educated guess and risk. So two things, if you guys are interested as I put this meetup together, what you need to do is text your first name and your email address to that number. If you don't know, if when I turn the slide, if you forget the number, do you see a picture of my face? Look at Dave. You'll see below him, it says Dave Fernecke. If you look below me, what do you see, Dave?
I see the 805-915-2525.
Correct. So when I come off of this, if you still, I just need your name and email address because I'm going to put you on an email list so you can look at that. And so we're going to learn to read charts. We're going to learn to read charts of Amazon, Apple, the Dow, the S&P 500, the iShare REITs, gold, silver, whatever. What we're not going to do is tell you you should buy it or you should sell it. You're going to have to make that decision. So why don't you open it up for questions?
Yeah, there was a question on the board, and Richard, do you want to unmute yourself?
On the what?
I'm talking to Richard. He had a question in here.
Open him up. Let him ask a question.
I did.
Hi, Richard. Richard?
I unmuted him.
Well, maybe someone else wants to ask a question.
Yeah.
Yeah, Howard, this is Sri. I can ask a question.
Sure.
So you were talking about look at what happened in the past 6 months. So are you trying to determine what is the max and min price for that market when you look at the 6-month interval? So why were you looking at the past 6 months when you were? I didn't understand why we are looking at the past 6 months.
Okay, which chart are you referring to? Because there were charts that we were looking back over the last 54 years. Which chart are you referring to?
I think you were looking at days on market and where the price was.
Yes.
You combined those two charts and looking at 6 months in the past. And I didn't know what you were trying to correlate from that.
Okay. What I was saying is, if you took a look at days on the market, if you look at the chart at days on the market, and let's say you are looking at one where the chart is saying it was 54 days on the market. It also gives you the data of when that data point actually printed. So it could have been a year and a half ago. It could be 6 months ago. It could be 2 years ago. Whatever that date you can extract, you can go back and look at what prices were. You can go back and look at what the economic conditions were, and then correlate that economic condition to what is happening here. Remember, I talk about the butterfly effect. When you have a complex system, it is made up of different parts. And if the parts are not behaving in sync, something's going to change. So I hope that answers your question. If it doesn't, say yay or nay, and I'll try and clarify.
I got it. Thanks.
Did it
Got
answer?
Thanks. Yes,
Did it answer your question?
Yes, it did.
Okay.
Thanks.
I know it's a little bit complex because you literally are I have literally read thousands and thousands of charts for over almost 40 years because I am a technical analyst. And so when I look at charts, I don't even have to mark them up anymore. I see it. But I want to teach you guys how to mark it up so you can actually see it. Because a chart is nothing more but supply and demand, buyers and sellers fighting it out every single day. Next question.
There's a question here: is why aren't you playing the stock market?
Why am I not playing the stock market?
Yep.
What makes him assume I'm not?
Dude, it's just a question.
I do play the stock market. In fact, I have two young boys, one 21, one 19, and they have been taught to play the stock market since they were 14.
Okay. Okay. Richard, are you there? You want to unmute yourself? You had a question. Anyway, Richard's question was, how would, because since the market is moving more towards seller financing, and to that point, Richard was asking about how would you structure a seller finance deal, a two-note deal in this market or any market. And it really gets down to what the seller needs, but more specifically, set that note up so that it can be broken up, or create a first, create a second, get at least 10% down, sell a partial on the first if you're doing the carry. It's just being creative with that at a reasonable interest rate. Reasonable could be 7-8, and for a person in this type of scenario, a buyer in a penalty box, also getting a strong amount of money down, at least 10%, if not a little bit more. Do the RMLO stuff on it in terms of the qualifications, but it's pretty straightforward. And if anybody wants to talk about that after the caller has any questions on that structure, we can certainly go over that.
Yeah, that's your bailiwick.
Exactly.
I do know how to do it, but I'm not here to A, step on toes, and B, the focus of this is to give them the information of how to assess value and price. So in a seller finance situation, what are you going to finance? You have to come up with a price in which you're going to start, and then everything else is just terms and condition.
Right. Right.
And the charts will give you that.
But again, like you said, don't be too aggressive on your pricing, because if that value dips and the people paid up here, they're going to be more inclined to walk away down the road and create a negative issue on that.
Yeah, because you're better off maybe structuring it, taking a little more down. So you look at it and you go, okay, the price is at 100,000. Maybe I can incentivize him at 95, but he needs to put on a little bit more. Instead of 3,000 down, let him put 5,000 down, and then run your numbers and see how it works out.
Right. And then also, given that you're taking back paper on the first, you probably want to recoup some money over and above the down payment. You could sell a partial. So to that point, you want to set up your partial investor to win.
Bingo.
And make it easier for you to sell with good analytics.
Bingo. Because what will happen is if you sell the guy at a price and then the price goes down and he's upset and you sell off your partial, you just create yourself a whole mess of headaches.
Yep, you don't need that because there's nothing definite out there about what's going to be happening. So why not set the stage for success instead of setting it on a quicksand bottom?
One thing I want to make people understand that they're not realizing, the more we move forward in time, the more companies like Zillow are going to be looked upon as being the true price, because they're going to be brainwashed into it being the true price. The banks are going to look at it. They're all going to look at it. And so the fluctuation around that is going to be fairly minor. So to understand that at this point in time and to master the use of it is the ability to argue around that price. But it's going to get, it's going to get harder and harder to argue around that price because unless there's an intangible that Zillow can never ever think, and that is the wife says, I don't care, I want that house.
You said something really enlightening to me a couple hours ago, Howard, that it was just a passing thought, but I thought it was interesting. You said something to the effect, because of AI and the way Zillow is evolving, that home appraisers might even go away and the banks will rely strictly on Zillow. Would you want to share a little bit more on that?
Have you ever heard the term AVM?
Yeah.
What does it stand for?
Well, it's a remote valuation.
Automatic valuation matrix.
Right.
What do you think the inputs are?
Don't know. I guess
They're
Zillow.
the same. They are like Zillow.
Okay.
They are like Zillow.
So therefore, if you're looking at a pool of notes, you could look at a lot of different sites, which I do. And 3 years ago, I'd put marginal stock in what Zillow said. It was just a benchmark to look at. But
Zillow is getting closer. Okay, I don't know if there is any engineer. I think I saw Guillermo, and he's an engineer. An average price is the line you draw through if I took a bunch of stuff and throw it up against the wall, it's going to scatter all over the wall. And each little, let's say it was marbles or darts or whatever. And I say, take a line and draw it through there to represent the average. What you will see is that some of the darts are close to the line and some of them are far away from the line. And those distances are what they use to calculate what we call standard deviation. And standard deviation is how we measure risk. So the further away from the Zillow price you get, as Zillow becomes more accurate, the more risk you're taking.
Okay. Okay. All right. Lisa, are you unmuted? Or could you be? You want to jump in? I know you had a question. Maybe not. Okay. Does anybody else have any questions, generically speaking, or specific? I don't see anything in the chat box. So, okay, let me pull this over here, Howard, for a minute. Can you see my screen?
Yeah, okay, there you are.
Okay, all right. So to that point, here's my advertisement. If you have some notes that you want to sell, I am a buyer. I love to buy partials. If that is the case, or you know of anybody, have them come my way, or they can go directly to my website, buymyloan.com. Buymyloan.com.
Dave, do you buy partials on seconds, performing seconds?
I do not work in the second market whatsoever. Again, it's mitigating risk.
Sure. How you look at it.
Yeah. Also, everything Howard was talking about was due diligence. Everything. On YouTube, I have several videos there. I'd appreciate if you go in there, and at least open them and just like them. That would be great, just to get the views, and you get the thumbs up if you would. That would be wonderful, just as a favor to me. And that's my contact information there. So again, that's all we have right now, unless somebody has some things that they want to. If you want to unmute yourselves, we can go with that, or other that we can just call it a wrap for right now.
Dave?
Yes.
Oh, it's Annette.
Hi.
So does that mean, I mean, I tend to look at the other valuation services as well as Zillow, Redfin, and are they all going to be trending then in the same direction?
The answer is yes. The answer is yes.
Yeah. Call them back.
Yep. They're all going to the AVM method.
Well, if that's the case, then will all the different valuation services become somewhat alike?
I don't know, Howard. It's all garbage in, garbage out.
Here is what drives this. We are living in a massive deflationary era. And so all businesses are trying to get to buy and deliver service cheaper and cheaper and cheaper and cheaper and cheaper. And technology is a deflationary force. As I tell people, in the olden days, if you were the president of of a company, you call in your secretary. She takes shorthand. She takes it to the secretarial pool. They type it up. She brings it back. She gives it to you, and then you sign it off. Today, you're lucky if you have a secretary. You got to type your own letters. It's called email, because technology has gotten rid of those people. So the point I'm trying to make to you is, yes, the other people are going to do it. They're all going to use the same input, but their AIs are going to interpret it differently. But they cannot interpret it so differently, because if they give you a number that is referred to in statistics probability, who remember when you go to school, you hope they grade on the curve. Well, it's the bell curve. Well, the very outer ends of the bell curve are called outliers. So they have to make certain that they're not too far outside of that, because if they are, no one's going to take them seriously. So even though they're all moving there, they're going to be fairly close to each other, because they don't want to go what we call beyond one standard deviation. I know I'm getting fairly technical. All I have to tell you is, as time goes by, the variables become the same. The AIs are going to almost start looking like each other, and the difference is going to be negligible.
And we're probably not that far away from that, are we?
Well, if you remember, I said to you in February, when I remember in January, a gentleman by the name of Stan Harley, who I highly respect, came and he said, based on what he was looking at, he saw nothing going to happen for the next 2 years. And I believe him that he was right, because he can't see beyond his 5 minutes any better than any one of us can. He just has to look at his stuff and do what he needs to do. But he never really say, okay, what happens after that? So when I came there, I said, let's take a look at what is likely to happen after that. And I said the two things that I believe are going to change our lives is quantum computing and 5G. But I thought that would take another 10, 12 years out. Well, I think it's sped up. And it's as simple as this. How many people on this Zoom, parents or family member 2 months ago would have, we said, get on a Zoom meeting, they would get on? Our behaviors are changing, and the way we adopt things are changing. Another thing I want to point out to you, how much data and these things, go back to 2008, before the crash. The top 5 companies in the world were oil company and industrial companies. None of Amazon was number 1. Apple wasn't number 1. Facebook never even was public. Fast forward today, and they are the leaders. So fast forward 10 years down the road, I will guarantee you none of those 5 names I call you are going to be the top. Things are changing. And they're rapidly changing, and it's all because of information technology. And what I am telling you, if you know how to read a chart, you might not know what's going to happen tomorrow, but you are going to know when the trend has changed.
Got it. Got it. Okay.
Dave, this is Guillermo.
Hi, Guillermo.
Hi, Guillermo.
Hi, Howard. How are you? Hey,
Hello, my engineering friend.
I just wanted to second what you were talking about a few minutes ago. My son-in-law happens to work for Redfin, for Red Hat, or whatever, and he's a software guy, and he's been there for a couple of years. And the amount of he works mainly on the quote back end, but in talking to him, there's a tremendous amount of effort being put by, at least by his company, into basically making the platform a lot smarter, a lot more accurate, whatever it is. You know,
it's called intuitive learning. That's what AI is. Intuitive learning.
He gave me a big spiel about how their models were better than Zillow's and everything else. And the other point I wanted to make is a point you made a while earlier about things drifting towards Zillow values. It already is when you're looking at selling a house and so forth right now in today's market. Customers will invariably quote Zillow as the gospel in terms of that. And I believe the reason is that they believe Zillow to be an unbiased opinion of value, as opposed to, if a realtor tells them, well, your value is worth so much, they're suspicious of that number because the realtor has a stake in the transaction, where Zillow has no stake in the transaction. And so there already is a drift in that direction, quite severe. When Zillow first came out, everybody would say, oh, Zillow doesn't count, it's all wrong and whatnot. Well, maybe it was then, but now it's not there. Now definitely Zillow is a value you have to definitely consider in evaluation.
So here's a little trick. Let's say you want to sell your home. You look at the charts and you realize things are weakening. By the way, if you go back and look at medium home prices before 2008, you will have realized that it started dropping around 2006.
Yep.
Most people don't even realize that.
We'll see you on the next call, which will be probably just after the 4th of July.
Thank you very much.
Thank you all.
Bye.
Bye.